Right now, global manufacturing is throwing absolutely trillions of dollars into this massive research and development funnel.
Oh, yeah. Trillions.
And for a huge percentage of those companies, that money is just vanishing into thin air. I mean, you probably think the rules of business are simple, right?
That's people do, yeah.
You pour capital into R&D, you invent some groundbreaking technology, you launch it, and then you just watch your productivity and your profits skyrocket.
Right. It's treated as the ultimate capitalist common sense, a totally straight line from investment to massive growth.
Exactly. But today, we are looking at the mathematical proof that shows why this common sense is actually a devastating trap. It is a total slap in the face.
It really is.
We are unpacking why massive R&D investments often end in total productivity stagnation. So, welcome to the deep dive.
Thanks. The scale of this illusion is just phenomenal. We're going to examine why, for so many of these manufacturing giants, that R&D funnel leads absolutely nowhere.
It's just a total black hole.
Exactly. The fatal flaws in corporate strategy, the reasons why billions are wasted, they hide precisely in what everyone considers conventional wisdom.
So our mission today is to decode an immensely dense, really groundbreaking economic paper. We want to extract the brutal mathematical truths about how innovation actually works in the real world.
And we are dismantling the old theories that promised all these endless riches.
Yeah, we are going to expose the hidden traps, things we are calling the adjustment cost assassin and the broken flywheel.
I love those terms.
Right. And we're basing all of this on a specific document. It's NBER Working Paper 19074, titled Dynamic Models of R&D Innovation and Productivity. It's panel data evidence for Dutch and French manufacturing.
Yeah, and the authors here are essentially four econometric titans: Wladimir Raymond, Jacques Mairesse, Pierre Mohnen, and Franz Palm.
Just absolute heavyweights in the field.
Oh, completely. And what they have done is construct the most rigorous, cold, dynamic, microeconometric model ever applied to this topic.
This isn't some abstract theory.
No, not at all. They didn't just look at a quick snapshot. They spent years analyzing three massive waves of the Community Innovation Survey, the CIS.
Tracking the exact same companies over time. Right?
Yes. Tracking the exact same manufacturing firms across a 10-year period from 1994 to 2004.
10 years of data.
10 years. They built this insane mathematical apparatus to see what actually happens to a firm's internal machinery over a decade when they try to innovate.
And the results just completely challenge everything we think we know. So let's start by looking at how economists and policymakers got this so wrong for so long.
It's a huge blind spot.
Because for decades, the dominant academic narrative promised us that innovation brings these massive, almost guaranteed returns.
High margins, huge growth.
Exactly. But reading through this paper, it becomes super clear that those older studies were essentially interviewing survivors in a graveyard.
That is a perfect way to put it. That survivor bias skewed the entire macroeconomic picture for years.
How did they make such a big mistake?
Well, historically, the literature relied heavily on models like the Grilich's augmented production function, which goes all the way back to 1979.
Okay.
Or they used traditional static CDM models. But the problem is, those older models relied entirely on cross-sectional data.
Which is just a snapshot, right?
Exactly.
Like taking a photograph of the economy at one single moment in time. Like taking a picture of the year 1998, seeing a bunch of companies spending on R&D and making profits, and just drawing a straight line between the two.
A single photograph. And the fatal flaw of that photograph is that it cannot eliminate what econometricians call unobserved firm heterogeneity.
Okay, I want to stop right there and really dive into that term, because unobserved firm heterogeneity sounds like the kind of academic jargon that puts people right to sleep.
Oh, it definitely does.
But it's actually the invisible dark matter of the business world. What does that actually mean if you're standing on a factory floor?
So it refers to the unique invisible traits of a specific company that don't ever show up on a standard balance sheet. It's the corporate culture. It's the specific historical relationships they have built with their suppliers over 50 years.
Oh, I see.
It's the unspoken institutional knowledge of the senior engineers who have been there forever. The risk appetite of the CEO.
The hidden stuff.
Right. When you only look at a static snapshot, you cannot mathematically tell if a company is succeeding because of the brand new R&D they just funded or because they just have incredible unobserved heterogeneity.
Meaning they're just a great company anyway.
Exactly. They have a great culture and brilliant management that would have made them highly productive regardless of the new R&D.
So the static model gives the new R&D project all the credit, when really the company is just inherently well run from the start.
It's a massive false positive.
But I have to ask, if these older cross-sectional models were fundamentally flawed by this unobserved heterogeneity, why did brilliant economists use them as the gold standard for decades? Were they just totally ignoring the obvious?
It wasn't ignorance, it was a profound technological and mathematical limitation at the time.
Just didn't have the tools.
Right. In 1979 or even 1989, dynamic panel data of this magnitude simply did not exist.
That's a lot of data to crunch.
It's massive, tracking thousands of moving targets across different countries, matching subjective survey data about innovation with hard, objective accounting data over a 10-year span that requires a massive data collection infrastructure.
And a lot of computing power, I imagine.
Exactly. The computing power required to isolate those invisible variables using multiple simultaneous equations where the errors are correlated across time, it just wasn't feasible back then. The architecture Raymond and his co-authors built here is incredibly complex.
And that complexity finally allows us to see the graveyard I mentioned earlier.
The survivor bias.
Right. Because in a single snapshot, you only see the companies that survived their R&D gamble.
You only see the winners.
You completely miss all the companies that poured their capital into a radical new technology, failed to find a market, and went bankrupt. They aren't in the snapshot because they literally no longer exist.
It's a huge data gap.
It's like evaluating the safety of skydiving by only surveying the people who successfully landed on the drop zone.
Right.
While you completely ignore the ones whose parachutes didn't open.
And the policy implications of that blind spot were massive.
How so?
Well, it created an environment where governments, venture capitalists, and boards of directors blindly pushed for more and more R&D. They assumed the returns were a guaranteed law of physics.
Just a money printer.
Yeah. They believed every bet wins because they only read the data generated by the jackpot winners in the news.
So once the authors built this new econometric telescope to track the same firms over 10 years, the illusion of guaranteed returns just completely vanished.
It evaporated.
And when they pointed this telescope at the manufacturing sectors of France and the Netherlands, they didn't just find slightly different numbers. They found a complete clash of ecosystems.
Two entirely different worlds.
Two entirely different species of business survival. Let's break down this clash.
The microstructures of these two economies provide a perfect natural experiment. In the French sample, we are looking at 1,920 firms.
That's a huge sample.
It is. And the average size is massive, 691 employees, with the median well over 100. This is an economy completely dominated by large-scale operations.
Giant corporations.
Right. But in the Dutch sample, there are 12,228 firms, but the average size is only 222 employees, with a median of just 96.
So it's heavyweights versus middleweights.
Exactly. Elephants versus cheetahs.
And the data shows that when these two groups face the pressure to innovate, their microeconomic structures react in fundamentally different ways.
It's fascinating to watch in the numbers.
In France, the massive firms, those with over 500 employees, they completely dominate the landscape. They account for 51% of all the product innovators.
Yeah.
The giants are the only ones really playing the game.
Because they have the resources.
Right. But in the Netherlands, it is the medium-sized enterprises, the ones with 50 to 250 employees. They are the primary engine, making up 65% of the innovators.
What we are looking at here is how different regulatory environments and industrial histories weave completely different survival genes.
Revival genes, I like that.
Yeah. France represents an economy where innovation is a game for the giants. These firms have deep pockets, massive historical accumulations of capital, and significant regulatory moats.
They can afford to fail a few times.
Exactly. They can absorb the massive upfront costs of long-term research. The Netherlands, on the other hand, represents a highly outward-facing, hyper-competitive, export-driven economy.
Because they're a smaller country.
Right. They don't have a massive domestic market to fall back on. So for those Dutch mid-sized firms, agility is literally the only way to survive the international markets.
Which means there is absolutely no one-size-fits-all playbook for corporate strategy.
Not at all.
If you are operating inside a massive multinational, the French model is your reality. You rely on scale and endurance.
You're an elephant.
Right. If you were in a mid-sized firm, the Dutch model is your blueprint. You survive on speed and high asset turnover. You're the cheetah. But this brings up a massive, totally counterintuitive twist in the data, a real slap in the face. We call it the scale illusion, or the twilight of the scale premium.
This is one of my favorite parts of the paper.
Because today, there is this absolute worship of giant tech companies and mega corporations. We assume that a massive company with billions in the bank must be infinitely more innovative than a smaller competitor.
The assumption is logical on the surface, right? I mean, more capital means more scientists, which means more patents, which translates to a higher intensity of innovation.
It sounds perfectly reasonable.
But the mathematical reality of this 10-year panel tells a completely different story.
Break it down for us.
The researchers found that once a firm actually steps over the threshold to become an innovator, once they make the binary decision to introduce a new product size, no longer provides any advantage whatsoever.
Wait, really? None.
None. The scale indicator variable in the equations drops to complete insignificance. Larger firm size does not lead to a higher innovation intensity.
Just to clarify for everyone, innovation intensity is the actual percentage of a firm's total sales that come from those newly invented products, right?
Correct. So a massive corporation might have huge overall revenue, but the share of that revenue driven by fresh innovation doesn't scale up just because they have 10,000 employees instead of 200.
That is wild.
A giant elephant can afford the incredibly expensive ticket to enter the race. It has the capital to build a state-of-the-art facility, but once the starting gun fires, the elephant doesn't run any faster than the cheetah.
Because the bureaucracy totally cancels out the cash advantage.
Exactly.
You might have an absolutely unlimited R&D budget, but if you also have 20 layers of middle management that have to sign off on a single prototype, your speed to market is completely destroyed.
The marginal management costs skyrocket. A sheer complexity of steering a massive corporate ship drags down the efficiency of the R&D output.
It's like trying to turn a cruise ship.
Right. Meanwhile, the Dutch mid-size firms have less total capital, but their R&D is highly elastic. Every euro spent translates into new products quickly because the survival of the firm literally depends on it.
That is a staggering realization, especially for anyone relying on the idea that merging two massive companies will magically double their innovation rate.
It never works that way.
The data shows you're basically just buying a heavier saddle for the exact same horse.
That's a great analogy.
But exploring who is innovating brings us to an even harder problem the authors had to solve. How do you even measure innovation in the first place?
The measurement problem. This is where it gets really deep.
Because up to 41% of the Dutch firms and 26% of the French firms show discontinuous innovation in the survey.
Right, discontinuous.
Meaning, one year they report brilliant new products, and the very next year they report zero innovation. Nothing. If you were just looking at their annual reports, the metrics look like a flatlining heartbeat that just spikes randomly.
And this discontinuity is a massive methodological hurdle. Real structural innovation isn't a light switch.
You can't just turn it on and on.
Exactly. An engineering team doesn't just wake up on a Tuesday, decide to innovate, and turn it off on Wednesday. It is a deep, ongoing current within the company.
So how did they measure it?
To capture this reality, the authors had to scientifically deconstruct the metrics into 4 distinct measurements of innovation output. They had to peel the onion, essentially.
Okay, let's peel that onion. Let's break down those 4 measurements, because the difference between what we see on the surface and what is actually happening underwater is critical.
Okay, so the first measure is the observed binary variable. This is the absolute simplest way to look at it.
Just a yes or no.
Right. Did the firm introduce a new or significantly improved product to the market in the last 3 years? Yes or no? 1 or 0?
Which is an incredibly blunt instrument.
Very blunt. It doesn't tell you much. So the second measure is observed innovation intensity.
How does that do?
This asks a much more specific question. What exact percentage of your total sales this year came from those new products?
Oh, okay.
This is a continuous number. It provides much more detail, but it is highly vulnerable to market fluctuations and external noise.
Right, because you could invent a genuinely revolutionary product, but a global supply chain crisis hits, and literally nobody buys it that year.
Exactly.
So your observed intensity looks terrible, giving the impression that your R&D totally failed, when in reality, the innovation was successful, but the market timing was just awful.
Precisely. And that is exactly why the authors introduced the concept of latent variables.
Latent variables, the underwater stuff.
Right. These represent the underlying true capability of the company, completely stripping away the market noise. So the third measure is latent propensity.
What does that measure?
This models the invisible underlying desire and structural capability of the firm to innovate, regardless of whether they actually pushed a product out the door during the survey window.
That makes a lot of sense.
A firm might be 2 years into a massive, highly complex 5-year R&D cycle. The observed binary measure would label them as zero innovation.
Because they haven't launched anything yet.
Right. But the latent propensity metric captures the high level of ongoing activity behind the scenes.
It's the iceberg. The products actually launched and showing up on the balance sheet are just the tiny tip of the iceberg visible above the water.
Exactly.
But the latent variables are measuring the massive hidden underwater reserves, the tacit knowledge of the engineering team, the half-finished prototypes, the culture of problem solving.
And the fourth measure completes it. That's latent intensital, which calculates the true potential share of innovative sales if market conditions were perfectly normalized.
Okay, so we have these 4 layers.
Right. Now, to actually use these latent variables mathematically to peel away the noise and isolate the true unobserved heterogeneity we talked about earlier, the authors deployed some extremely heavy econometric techniques.
I saw those in the paper.
Specifically, the Wooldridge projection method and Gauss-Hermite quadrature.
Okay, I promised the listener we wouldn't get bogged down in pure academic theory without explaining the mechanics. We need to explain how these mathematical tools actually work. What is the Wooldridge projection actually doing to the data? It sounds like a sci-fi weapon.
It kind of acts like a mathematical scalpel. To understand the Wooldridge projection, you really have to look at the starting line.
The starting line in 1994.
Yes. When the researchers began observing these firms in 1994, the firms didn't just start from zero. They brought decades of historical baggage at their initial conditions.
Some were already rich, basically.
Exactly. Some companies already possessed a massive portfolio of patents and a deeply ingrained innovative culture. Others were just total dinosaurs.
Right.
If you just measure their progress from 1994 to 2004, the ones that started with a massive advantage will look like they are highly efficient innovators today.
But that's a mirage.
Right. Because you don't know if that success is due to their new R&D spending or just the massive momentum of their historical baggage.
So how does the math fix that?
The Wooldridge method mathematically projects the unobserved individual random effects onto the initial values of the firm, their exact state in 1994, and their average attributes over the decade.
Okay.
By conditioning the equations on these starting variables, the model effectively holds that historical baggage constant.
It freezes it.
Exactly. It slices away the firm's innate genetic advantages, allowing the researchers to isolate and measure only the new efficiency gains generated by the R&D efforts during the survey period.
It mathematically levels the playing field.
It does.
It takes the legacy corporation that inherited $1 billion in IP and the scrappy mid-sized firm and equalizes their starting position so we can see who is actually generating more output per dollar of R&D today.
That's exactly what it does.
Okay, that makes sense. And what about the Gauss-Hermite quadrature, another incredibly intimidating term?
It is intimidating, but it's essential. When you build a dynamic model tracking unobserved heterogeneity over time, the probability equations become so complex that they don't have a clean, closed-form algebraic solution.
The computer just can't solve it.
The computer cannot simply solve for x. It's too messy. So Gauss-Hermite quadrature is a numerical integration technique.
How does that help?
It transforms that impossibly complex continuous probability curve into a discrete sum over very specific points, or nodes. It allows the model to approximate the true distribution of these invisible traits across thousands of companies with incredible precision.
So they use the Wooldridge projection to handle the historical baggage, they use the quadrature to solve the impossible probability curves, and they finally have these 4 pristine measurements of innovation.
They've isolated the variables.
And then they run a test, the Vuong non-nested test.
The ultimate showdown.
Right. They run this test to see which of those 4 measurements is actually the best predictor of a company's future productivity. Does the blunt yes-no work best? The sales percentage? Or the deep underwater latent variables?
So the Vuong test is designed to compare 2 models that are not derived from each other to see which is closer to the true distribution of the data.
It's basically pitting them against each other in an arena.
Exactly. It is the ultimate academic showdown between the intent to innovate and the hard market results.
And what was the result?
A tie.
Wait, a tie.
A mathematical tie. The z-statistics yielded p-values far above 10%. Meaning they could not reject the null hypothesis that both models are equally close to the true data.
That's fascinating.
The latent models and the observed market models are mathematically equivalent in predicting future efficiency.
Okay, wait, I have to challenge that conclusion on behalf of the listener.
Go for it.
If a company has a great culture of innovation and high latent propensity, but they never actually launch a product the market wants to buy, How can you possibly say that is mathematically equivalent to a company generating 30% of its revenue from new products?
It's a fair question.
At the end of the day, latent potential doesn't pay the payroll. Hard sales do. So why does this test matter?
That is the exact debate that has divided economists for decades. But you have to separate short-term cash flow from long-term structural productivity. The VUM test proves that the capability to innovate that latent underwater mass of the iceberg is just as reliable an indicator of a firm's underlying technological efficiency as the quarterly sales numbers.
Even if the sales aren't there yet.
Even if they miss the market. A firm might miss the market timing on one product, causing observed sales to drop, but if their latent capability is high, their overall factory productivity and efficiencies still rise because the internal processes have been permanently upgraded.
I see. The factory got better even if the product flopped.
Exactly. Proving this equivalence is monumental because it validates that measuring the deep, invisible culture of a company through survey data is scientifically sound. Economists can finally stop arguing about the thermometer and start treating the fever.
So for the investors listening, relying solely on products launched this quarter is a dangerously incomplete metric.
Highly incomplete.
The latent capability, the accumulated tacit knowledge, the patents sitting in the drawer, that is what actually dictates long-term survival.
It's the true measure of health.
But this brings us to the most dangerous phase of the innovation cycle. The part where companies actively destroy their own success because they misread the data. The paper outlines two massive traps.
The indigeneity curse and the adjustment cost assassin.
The indigeneity curse and the adjustment cost assassin. These sound like movie villains. Let's start with the indigeneity curse.
These findings are perhaps the most critical for any management team. So in econometrics, if a variable is exogenous, it means it happens to the system from the outside.
Like a regulatory change or a meteor strike.
Right. It's totally separate. If a variable is endogenous, it is generated within the system, deeply intertwined with everything else.
And for a long time, management treated innovation as an exogenous shock.
A huge mistake.
They looked at a new product launch as an isolated line item on a spreadsheet, totally separate from the hiring, the training, the daily culture of the firm.
And Raymond and his co-authors proved that if you make that mathematical assumption, if you treat innovation as an external exogenous variable, the calculated returns on your R&D totally collapse.
The numbers just fall apart.
The model shows that the causality is highly sensitive. Innovation and productivity share the exact same internal ecosystem.
We need to translate the coefficients here to really understand the scale of this curse, because it is a bloodbath.
It really is. Let's look at the numbers.
If you treat innovation as exogenous in the Netherlands, the productivity elasticity, which is the actual bump in factory efficiency you get from innovating it, drops from 20% down to just 4%.
It loses 4/5 of its value instantly.
In France, it is even worse. The elasticity of innovation intensity drops from 0.12% to an totally insignificant 0.01%.
And to put 0.01% into a business reality, it means that if a French company doubles its innovation intensity,
Literally pouring millions more into R&D.
right, and successfully doubling the share of new products, if they do that, its actual labor productivity barely moves by 0.1%.
It is completely indistinguishable from statistical noise.
Exactly. It looks like it did nothing.
Which means if a CEO ignores the endogenous nature of the company and just looks at that exogenous spreadsheet, they will see that 0.01% return and immediately shut down the R&D department.
It'll fire everyone.
They will think the innovation failed, leading to massive, tragic underinvestment. You literally kill the golden goose because you were using the wrong scale to weigh the eggs.
That's exactly what happened.
But even if you manage to avoid that curse, you still have to face the assassin. The paper finds a statistically significant negative correlation between the idiosyncratic errors of innovation and productivity.
This is the adjustment cost assassin, and it is brutal.
How bad is it?
In the French model, that negative correlation in the residuals ranges from negative 0.206 to negative 0.570.
Okay, translate that for us.
In plain English, this means that the exact moment a company successfully introduces a new innovation, its overall labor productivity experiences a violent short-term drop.
A drop, not a rise,
Yeah.
a violent drop. I want everyone listening to visualize this because it happens in every single industry. It's exactly like deciding to completely remodel your kitchen.
Oh, this is a perfect analogy.
You hire the designers, you buy the expensive marble countertops, you are heavily innovating your house. But the day the contractor actually arrives with the sledgehammers, your ability to cook meals drops to absolute zero.
There is dust everywhere.
The fridge is plugged into a random hallway outlet. You are eating lukewarm takeout in the living room for 3 months. To a naive observer who walks into your house during week 2, the remodel has totally destroyed your kitchen.
Your culinary productivity is deeply negative.
Deeply negative. But it is just the adjustment cost.
And we see the mathematical shadow of that exact scenario on the factory floor. When a new product lands, it requires new assembly lines to be built.
Everything gets paused.
Workers have to be pulled off the line to be retrained on new CAD software or new machinery. The highly optimized, perfectly efficient old processes are deliberately broken.
To make way for the new ones.
Right. Supply chains have to be rerouted. The negative correlation in the dynamic equations captures this chaos perfectly. Successful innovation immediately destroys short-term productivity.
How many visionary product managers have been fired by angry boards of directors because productivity dropped right after a major launch?
Probably thousands.
The board looks at the quarterly earnings, they see the dip in factory output, they panic, and they fire the architect right when the new kitchen is halfway done.
It happens constantly because the market expects a smooth upward trajectory. They want a clean line on a chart. But this 10-year panel proves that the chaos is not a sign of failure.
It's part of the process.
The efficiency low point is the mandatory toll you pay on the road to a higher technological plane. Any disruptive change is accompanied by short-term functional regression.
You have to go backward to go forward.
Exactly. If you do not account for the adjustment cost assassin, you will panic and retreat just as the roots of the innovation are really taking hold.
You have to endure the takeout in the living room if you want the marble countertops.
You really do.
Which transitions perfectly into the next major finding. Enduring that adjustment cost requires time, and it requires a massive financial shield to protect you while you are vulnerable. Let's talk about the 4-year echo and the monopoly shield.
The timeline of innovation. This is where the free market myth takes a big hit.
Right, because the narrative we usually hear is that scrappy startups in a perfectly competitive free market will always out-innovate lazy monopolies.
We love that story.
But the math in this study reveals a much darker truth about the nature of deep, hard-tech innovation. When facing the terrifying uncertainty of R&D, only the giant castles with monopoly profits dared to play the game effectively.
Let's unpack the time delay first, the 4-year echo. Capital markets today operate on an incredibly impatient timeline.
Everything is quarterly.
Hedge funds demand quarterly returns, 90 days. If you miss your 90-day target, your stock price gets punished severely. But the data shows that structural innovation operates on a geological timeline compared to the stock market.
Geological timeline, I love that.
The survey data measures R&D investments made in period T-1. And because of the way the waves of the CIS survey are structured, T-1 actually represents a 4-year lag.
4 whole years.
The econometric models prove that the R&D capital you deployed 4 years ago is the primary determinant of your innovation output today.
If an activist investor forces you to pull your funding in year 3 to boost quarterly margins, you lose everything. The seed just dies in the ground.
And we see a stark difference in how the two countries handle this delay. In the Netherlands, this 4-year lag has a highly significant effect.
What do the coefficients look like?
They are strong, ranging from 0.069 to 0.125. This means Dutch firms have built a microstructure that is highly efficient at translating that 4-year-old R&D expenditure into actual market products.
They're good at the waiting game.
Exactly. But in France, the translation efficiency is much lower, barely significant at the 10% level. The French firms spend the money, but 4 years later, the execution into products is incredibly sluggish.
Think about your own company or your own investments. Are you playing a quarterly game in a 4-year cycle? Are you pivoting your corporate strategy right before the 4-year seed sprouts?
Most people are.
The math says patience is a structural requirement, but patience requires oxygen. You cannot hold your breath for 4 years if you are starving. Which brings us to the monopoly shield.
The researchers examined lagged market share as a variable. This is essentially a proxy for market dominance, for excess rent, or what we loosely call monopoly profits.
The fat margins.
Right. And they found that lagged market share is highly significant in predicting future innovation intensity in both countries.
It is.
Very significant. The coefficients range from 0.021 to 0.096, which is a powerful statistical signal.
Does that mean a company literally needs to be a monopoly to innovate?
It means that true, hardcore technological innovation, not just slightly improving the battery life of a phone, but fundamental leaps, is a high-cost, extremely low-probability game.
Most of it fails.
The failure rate of basic R&D is massive. The data strongly suggests that excess rents, the fat profit margins you only secure when you dominate a market, are the necessary financial cushion.
The shield.
The shield. Without that cushion, the risk of bankruptcy during that 4-year lag or during the chaotic adjustment cost phase is simply too high to bear. Free market hypercompetition drives margins down to zero.
And if your margins are zero, you cannot fund a 4-year gamble in the dark.
You just can't. You'd go out of business.
That forces a complete reevaluation of antitrust philosophy.
It really does.
If regulators aggressively break up massive companies to increase competition and lower prices for consumers in the short term, do they accidentally destroy the only financial shields large enough to fund 10-year high-risk technological leaps?
It is the ultimate double-edged sword of modern capitalism. We dislike monopolies because they can charge high prices and become sluggish. But this microeconometric data indicates that the super profits of a monopoly might be the only mechanism capable of absorbing the brutal financial uncertainty of the innovation abyss. Small, perfectly competitive firms simply cannot survive the 4-year echo.
But wait. If the monopolies have all the cash and they have the shield, then logic dictates they should be driving all of human progress forever, right? Once a company gets to the top of the productivity mountain, they just keep innovating and staying at the top.
And that logical assumption brings us to the most depressing, totally counterintuitive fact in global economics. The ultimate black hole.
The broken flywheel.
One-way causality and the broken flywheel.
I genuinely had to read the tables in this section of the paper 3 times because it defies everything taught in business schools.
It completely wrecks the theory.
We assume capitalism works in a beautiful, infinite loop. A flywheel. You innovate, you get rich, you use the riches to fund more innovation, you get richer, you innovate more.
The compounding effect?
But the math in this 10-year panel takes a sledgehammer to that flywheel. It severs the loop completely.
Let's start with what the data does confirm. It confirms massive persistence in productivity.
What does that mean?
In France, the coefficient for productivity persistence is 0.531. In the Netherlands, it's 0.319. The initial productivity contribution is even higher, around 0.56.
So the rich stay rich.
This means that highly productive, highly profitable firms tend to stay highly productive.
Because they have a moat.
Yes, because the tacit knowledge we discussed earlier degrades very slowly. Brand reputation, supply chain dominance, accumulated patents, these act as a moat that protects the firm's efficiency for a long, long time. So the leaders stay leaders.
Okay, that makes sense.
But and this is the massive revelation. The hypothesis that success breeds success in innovation is completely dead.
Dead and buried. The data shows that past innovation has almost zero statistical effect on future innovation.
None at all.
In the Netherlands, the coefficient for lagged innovation predicting current innovation drops to between 0.004 and 0.025.
Which is entirely insignificant.
The ultimate finding of this massive study is that there's a strict unidirectional causality, a one-way street.
Innovation causes productivity.
4-year-old R&D creates innovation, which, after the adjustment cost, creates productivity.
But, and listen closely to the math here, productivity does not cause innovation.
The reverse feedback loop does not exist.
It's gone. The coefficients mapping lagged productivity back to future innovation probability are exactly 0.000 to 0.004.
The engine is turning the wheels, but the alternator is broken. The energy from the wheels never goes back to the battery.
It's a severed loop.
Why? I mean, if I am the CEO of a company that just hit peak productivity, I am swimming in cash. I have the monopoly shield. Why wouldn't I take that cash and build an even crazier R&D lab?
Because of the economic rationality of the frontier. The researchers capture this in the distance to frontier paradox.
Explain that.
They categorize firms into quartiles based on how close they are to the absolute peak of their industry's efficiency. DQ1 represents the frontier, the absolute best in the world. DQ4 is the bottom tier.
Okay.
You would intuitively think the firms in DQ1, possessing all the capital and the top talent, would push harder to break through to the next level.
To stay ahead of the pack.
But they don't. The regression models show their marginal performance and innovation totally flattens out. Being in the top quartile provides absolutely no additional boost to innovation intensity.
Because when you are at the absolute peak, there are no competitors left to copy. You are in uncharted territory.
Exactly. The cost of basic scientific discovery at the frontier is exponentially higher than the cost of incremental improvement for a mid-tier firm just trying to catch up.
The math changes.
The mathematical risk-to-reward ratio of pushing the technological frontier is fundamentally terrible. It is far safer and totally economically rational for the frontier CEO to take the excess cash and buy back stock, distribute dividends, or acquire safe adjacent assets.
They just play it safe.
They switch from being suicidal risk takers to defensive rent collectors.
It's like a starving artist. A starving artist in a freezing cold apartment makes a brilliant avant-garde masterpiece because they literally have nothing to lose. It's risky, it's wild, it's a huge innovation. They sell it for $10 million and achieve peak productivity. But instead of taking that $10 million and buying a bigger studio to make an even riskier painting, they buy a yacht. They go to the south of France, they start painting safe, boring little watercolors of sunsets for their rich friends. Efficiency kills the appetite for risk.
That is a brilliant analogy.
The adventurer becomes a fat king, sitting on a throne, using their resources solely to protect the castle.
The data strongly supports that analogy. The capital flows into efficiency, it generates massive rents, and then it pools there. It doesn't recycle back into the high-risk, 4-year echo chamber of R&D.
So it just stagnates.
This one-way causality is the macro explanation for global productivity stagnation. We look at the global economy and wonder why, despite massive tech giants holding billions in cash reserves, we aren't seeing radical new energy paradigms or transformative physical technologies at the speed we expected.
Because the black hole of the broken flywheel has swallowed all the capital?
The most successful companies in the world eventually, mathematically, lose their hunger.
So we have gone incredibly deep into the mathematical matrix today.
We really have.
We have decoded a decade of European manufacturing data through the brilliance of Raymond, Mairesse, Mohnen, and Palm. We've seen the static illusions, the clash of the elephants and cheetahs, the Wooldridge projections, the adjustment cost assassins, and the broken flywheel.
It's a lot to process.
What is the ultimate takeaway for the person listening to this right now?
The brutal, beautiful mathematical reality is that innovation is not a magic wand or a clean straight line. It is a grueling one-way street filled with survivor bias, delayed gratification, and violent short-term adjustment costs.
It's warfare.
It is. If you are a leader or a capital allocator, you have to discard the static illusions. You cannot rely on snapshot data to make dynamic decisions about the future.
Whether you are leading an engineering team, investing your life savings in a stock, or trying to understand the fate of global economics, you have to respect the mechanics of the real world.
You have to respect the lag.
Right. Respect the 4-year lag. Give your seeds the time and the financial shield they need to grow. Prepare your board of directors and your own psychology for the inevitable productivity drop when you launch.
You have to welcome the adjustment cost assassin as a necessary sign of progress, not a failure.
And above all, never assume that yesterday's success guarantees tomorrow's bravery.
Because the fat king rarely wants to go back into the jungle.
Which leaves us with a totally new, unexplored thought to chew on. A provocative idea that builds on the mathematical reality we've just uncovered.
I'm ready.
If the data definitively proves that high productivity and market dominance naturally extinguish the fire for radical innovation, because the frontier leaders mathematically prefer to buy yachts and defend their castles rather than explore the unknown, is the only way to save human technological progress, to actively, legally force the breakup of the world's most successful companies.
Wow. It is the ultimate paradox. We established earlier that they need the monopoly shield to fund the innovation in the first place. Yeah. But once they use the shield to win, the flywheel breaks and they stop innovating.
Exactly. If the flywheel is fundamentally broken by success, if efficiency naturally breeds extreme caution, do we have to force the kings off their thrones?
It's a radical thought.
Do we have to artificially shatter the castles, take away the monopoly shield, and throw them back into the terrifying hyper-competitive jungle just to restart the engine of progress?
To force them to be starving artists again.
If business really isn't a clean engineered equation, but a murky dynamic struggle for survival, maybe chaos is the only thing that keeps us moving forward. Something for you to chew on.